Hey guys, welcome back. We are going to begin our session with the tangency point M. That's the market portfolio here. Now, let's define capital market line once again. So, it refers to a two-asset portfolio. That's risk-free asset and market portfolio. We combine the risk-free asset with a various weight with the market portfolio, and then we can form this line. Now, there's something about this market portfolio here. Now, let's start with the line RFRA here. Remember the first assumption of capital market theory. We say that all the investors are actually marked with efficient investors, meaning that they are only going to make investments along efficient frontier. So, RFRA tells us that investors form a portfolio. So that's the portfolio possibility line of joining risk-free asset with various weights in combination with portfolio A, which lies on the efficient frontier. Now, that's RFRA. Now, it's similar with RFRB. So RFRB is when we form a portfolio possibility line with two assets. That's risk-free asset and efficient portfolio B. Now we change various weight with risk-free rate in combination with portfolio B. Now, see that RFRA and RFRB, even though A and B are both efficient, still RFRB line presents a higher level of efficiency compared to RFRA. See? That's the standard deviation C here. Now, it happens that when we connect RFR with any efficient portfolio on the efficient frontier, the lower lines actually represents a lower level of efficiency, and anything goes above this line represents a higher level of efficiency. So, in this process, we can increase the slope of this line here very slowly, until we reach the point of RFRC. And can we go any further than the C point? No, we cannot. Why? Because this is the line of tangency. If we go, say, right here, then this portfolio here is out of touch with the efficient frontier, meaning that it doesn't exist because efficient frontier represents the efficiency edge. It is the end of the efficient investment choice. There's nothing above this point. So we can only go about this far. So that means capital market line, because the tendency point here is the line that has the highest portfolio possibility line. We cannot go any further. The tangency line is the farthest way we can go. So that means capital market line reached the highest level of efficiency right here. It represents a higher level of efficiency compared to RFRB and RFRA and anything below it. Now, that's what we mean by the first feature of market portfolio. It has the highest portfolio possibility line. So, we say that we are looking at market efficient investors. So, they will only target the efficient investments, which especially give them the highest level of efficiency. So, they would prefer the market portfolio. Now, the market portfolio is one collective portfolio that contains every single risky asset in the world. Now, that's a collective portfolio. Now, you can imagine it to be, let's say, the whole universe of risky asset. Now, remember that one of the assumptions in the capital market theory is that the market is in equilibrium. So that means every single risky asset inside of this market portfolio has the weight that is proportional to their current market value. Now, let me ask you this question. Is market portfolio the riskiest investment choice in the capital market? Well, I would say not. Why? Because it is a collective portfolio. Say we have one single investment that has an upward trend, and there is another single asset that has a downward trend. So it is very likely for these two individual assets cancel out this trend of themselves. So when we have collect many of these individual assets, we are likely to look at a portfolio where the individual trend of this single asset are actually cancel out or balance out or offset with each other. So we are actually looking at a relatively stable portfolio in terms of its risk. So we say market portfolio is more like a representation of the average level of risk for the general population of risky investment. So if there is an investment choice that presents higher level of risk compared to market portfolio, it must deserve a higher level of return compared to the market portfolio as the compensation for taking on more risk. So that means we can actually reach to a point where it offers higher returns than market portfolio. Now, there are actually two ways we can achieve that point. Now, we can simply do investments along the efficient frontier, and we can go about this far. That's portfolio B, and it contains a higher level of risk, and that's why it deserves higher level of return compared to the market portfolio here. Now, there is actually another way to reach a high level of return compared to market portfolio. That is, we continue doing investments along the capital market line, and we can arrive at point E. So what is point E? Well, let's start by learning about point C here. So, capital market line can be seen as a two-asset portfolio, with one asset being the risk-free asset, the other one being the risky portfolio. So we change the weight of risk-free asset in combination with the market portfolio. So what happens at point C is that we put, say, half of money into the risk-free asset, and we put the other half into the market portfolio. Then we are going to land ourselves on point C. Now, at point M, we actually put all of our money into, let's say, 100% of our money into market portfolio. So if we want to go any further, we need to increase our investments. But we do not have any other money, so what do? We borrow. Remember, the capital market theory says that we can borrow and lend at risk-free rate with any amount we want. So that's what we do. We borrow money. Say, we borrow another 70% of the money we already have, and then we invest the proceeds and the funds we already have into this portfolio M. So that will allow us to arrive at point E. And point E has higher level of risk. Now, why? Say, previously, we have 100% of money being put into the market portfolio. Now, we borrow another 70% of the fund. That opens up our exposure to risk. Now we are actually facing 170% of the risk with the borrowed fund. Now that's what we do when we add leverage to our portfolio. We do not just enlarge our investment, we also enlarge or expand our exposure to risk. In this case, we are exposing ourselves to a greater deal of market risk. And we do that by opening up our investment scope and also our risk exposure. So that's why point E having a higher level of expected return, because we deserve it when we take on additional level of risk. So that's how we can arrive at point E. We introduce leverage. We introduce ourselves to a greater exposure to market risk. And higher risk leads to higher level of return. That's it. Simple as that. Now, we can see that point E clearly dominates point D. And we can actually see that E and C represents different level of risk and return combination. So for E, it has higher level of risk. For C, it has, lower level of risk. Now, what happened during these two parts, let's see here. Say this is C and this is E. Now, what happens into these two parts is that when we add the first half part, we are actually lending our money out at the risk-free rate. And for this part, we are borrowing money at risk-free rate. So we introduce leverage. Now, our final decision, our final investment decision, targeting the capital market line actually depends on our risk preference level. If we are more risk adverse, we would like a lower level of risk, we would be more likely landing ourselves on the first half of capital market line. Otherwise, if we welcome risk to our investments, we want a high level of return, we are more risk tolerant, then we are more likely to land ourselves on the second half of this capital market line. Now, here is one important theory being referred as separation theorem. Now, noticing that in this process, we must be targeting our investment along the capital market line if our investors are market efficient investors. Why? Because, like we said, compared to IFRA and IFRB, for any lines goes below the capital market line, capital market line at the tangency line have the highest level of portfolio possibility. So it is the only practical portfolio or investment choice on the market that allows us to get access to the highest level of efficiency. Now, both of these two investments are efficient. They offer different returns based on different risk level. So that means when we do investments along the capital market line, we're actually making only one investment choice in terms of our risky investments. That is, we would only pick the market portfolio. And then the market portfolio's weight can change depending on our financing decision, whether we are going to lend our money out at risk-free rate or we're going to borrow money at risk-free rate. Depends on our risk tolerance level. So that gives rise to the separation theorem. The investment decision being made is actually separated, or let's say independent from the financing decision. That's whether we are going to lend at risk-free rate or borrow at risk-free rate. Because we are market efficient investors, we would only target the investment that lies on the highest possible portfolio possibility line. So M is the only investment choice. That's the market portfolio. And the financing decision is separated from the investment decision because we make our investment decision based on our identity of market efficient investors, and we form our financing decision based on our risk tolerance level. Now, that's how these two theories, or let's say two decisions, got separated from each other. One investment decision, one financing decision won't be, let's say, interact with each other. Now, let's see a question here. Say, we are looking at a question with risk-free rate equals to 4% and market portfolio has a return of 9%. Standard deviation of the market portfolio is 10%. It goes without saying that the risk-free asset, it had 0 standard deviation. Now, we form a portfolio for these two assets. We can say that this portfolio is definitely will be landing on capital market line. Now, this capital market line portfolio has a total risk of 15%, which is higher than the market portfolio. And we want to know what is the weight of each asset if we want a risk level of 15%. Now, let's bring out the equation for capital market line right here. That's the expected return equation. And we insert everything we know into the equation. The first element is the risk-free rate. This is the standard deviation of the portfolio, and that is market return, and then that's the standard deviation of the market portfolio. And then we have the result of 11.5. So that is the expected return of this portfolio. Now, remember the expected return of this portfolio is a weighted average of the individual asset inside this portfolio. So we set the weight of risk-free asset as WRF, and the weight of market portfolio would be 1 minus WRF, and we times with each corresponding expected return. And we had the result. The weight of risk-free asset inside of this portfolio is actually minus 50%. So the minus sign indicates that we are in a short position, meaning that this is not the asset we own, this is the asset we borrow. So we borrowed 50% of the money we already have, and we invest 150% of our money into the market portfolio. Remember, the portfolio's weight is always going to be 100%. So if this one is minus 50%, then the weight of market portfolio would be 150. Now, there's actually an easier way to do this question. Now, see, the risk level of this portfolio is 15%, and the only risk source of this portfolio is the market portfolio, which have a standard deviation of 10%. Remember, we say that when we combine a risk-free asset and a risky investment into a portfolio, the risk of this portfolio is actually in proportion to the weight of the risky asset inside the portfolio. And 15% is 1.5 times of the market risk, meaning that we expand the risk level we are facing when we invest 100% of our money into market portfolio. So we open up our portfolio weight that is being put into the market portfolio by another 15%. So that allows us to have a risk level which is 1.5 times of its market portfolio variations. Now, easier as that. That's the end of this session. In next session, we are going to know more about risk elimination. All right, looking forward to see you in our next video. Bye-bye.